Earlier this week, one call from one economist and one team on Wall Street made a ton of headlines. It came from Goldman, and this was the quote from near the top of the Southside research. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. That was Jan Hatzius and the team over at Goldman Sachs. The chief economist joins us right now. And Jan, because of that, you've downgraded your forecast. Can you just walk me through this just a little bit more, the degree to which you think we will decelerate in the coming quarters?
We are looking for a pretty significant deceleration as we go into 2022. Right now, obviously 6.5% growth in Q2, probably more than that in Q3, but then we're at 1.5 to 2 by the second half of 2022. And that's partly because the return to full utilization in the service sector it's a slow process. Just one data point that I think is very important. The office occupancy rate in the United States is still only 30% of the pre-pandemic level. And even in Texas, which is most advanced, it's only 50%. And this, I do think those numbers are going to be much higher eventually, but we're still, it's a very slow process.
You're on 1.5 to 2% trend growth. Yeah, and that was amazing. Just to read that, 1.5 to 2% trend by the back end of 2022. So second half of 2022, Jan, you're looking for 1.5% to 2% GDP growth. Now, that's the call. Help me understand how you reconcile that with your call from the Federal Reserve. How does the policy call reconcile with the growth call that you're making?
Well, the policy call is that the Fed is still going to be very gradual in exiting from the current policy stance. So we have tapering starting in early 2022, announced at the December FOMC meeting, then a pretty gradual, 15 billion a meeting tapering pace. So it takes you until the end of 2022 until tapering is done. And then whether you get rate hikes thereafter is going to depend on whether the criteria that the Fed's laid out are met. So what are the criteria? 2% inflation, confidence that you'll be somewhat above 2% for a while, and full employment. When those conditions are met, they will hike. Our baseline is that that happens in late 2023, but I think the risks are towards the later side, could slip into 2024. And that is, somewhat later than what markets are pricing, I think, for all of these things. So I think it's consistent with a growth forecast that is still strong in the short term, but decelerates quite a lot because of the withdrawal of fiscal stimulus and less of a boost from reopening.
Okay, that said, some of the factors that you're talking about, like people getting back to the office and the Delta variant, will subside. Potentially it'll take a couple months longer, but will subside. I mean, why do you disagree with Citi macro strategists that actually put out a report today saying that the stagflation surprise regime is tactical in nature and shouldn't last more than a couple of months?
Well, I certainly agree on the inflation side of things that we, have seen obviously a big increase in inflation, and we do think that is transitory. We have a sharp deceleration in inflation in terms of core PCE. We think will be below 2% for much of 2022. So I think on that part, we certainly have a similar view. I think on the growth side, we've been very optimistic about the rebound in growth in 2021, basically because you've seen a massive amount of fiscal support and a big boost from reopening. And those things have not quite played out yet, but they are temporary. The reopening is a one-time boost to the growth rate and, permanent boost to the level, but a one-time boost to the growth rate. And fiscal actually turns into a negative impact in 2022 because a lot of the enormous support of 2021 isn't repeated in 22.
Sure, we're not going to get instant trillion-dollar money dumps like we got during the pandemic. It's not going to be instantaneous fiscal policy, but we're still talking about trillions of dollars in longer-term economic spending on Capitol Hill. That is making progress. I know it's spread out over a long time, but how do you factor that in here?
Well, I think that is the key point, that it's spread out over a long time. So the headline number is going to be very big. Let's say it's going to be $3 trillion when all is said and done. But there are two things to consider. One, maybe $1.5 trillion of that is going to be offset by higher taxes. And number two, it's spread over a 10-year horizon. So you basically have to divide all these numbers, $1.5 trillion or $3 trillion by 10. And then you're talking about something that's sort of in the 1% of GDP range and nowhere near the support that the American Rescue Plan provided for 2021. And what I'm most interested in terms of the impulse to growth, is what's the change from one year to the next? What do we get there? Fiscal support worth about 12% of GDP in 2021. And even with our assumption on fiscal, which is actually fairly expansive, we only get 4% of GDP in 2022. So that's an 8 percentage point reduction. Now, that's not an 8 percentage point negative impulse, because some of this, of course, is the flip side of a more normal economy, but it's still a pretty sizable negative impulse.
Yeah, and just quickly, just to round things up, you've done a beautiful job of explaining how you think growth will decelerate in the coming years, the coming quarters. Can you help me also understand how you expect the rate of inflation to decelerate as well? From the high rates we're at right now, does that persist into the new year?
We don't think so, because if you look at the high rate right now and the upside surprise, it's very concentrated in a small number of areas that are very likely to be temporary. The single most important one is used cars, and the used car market is already showing some signs of relaxation. We have data on auction prices, which have been going down over the last 6 weeks or so. That hasn't shown up in the CPI and PCE yet, but it will show up over the next several months. And so you're going to go from a positive impulse to a negative impulse, not just neutral, but a negative impulse as you go into next year. Other observations, I think wage pressure has been sizable, but looks quite temporary and probably related, at least in part, to the top-up unemployment benefits, which are expiring.
Yeah.
And then lastly, inflation expectations still seem very anchored, at least for the longer term.